All right, welcome back to our market outlook video today. The S&P 500 closed higher by 0.4%, helped out by Nvidia's earnings, which boosted the tech sector to a small degree. Not enough, though. Not nearly what we thought was going to happen last night or even at the open this morning. Defensive sectors like utilities and healthcare ultimately outperformed, with bond yields and the dollar easing, going down, supporting real estate and other yield-sensitive plays. Commodities were mixed. Silver was up, oil was down. Trade policies. This headlines were up and down today. So last night they seemed to be very positive. Today we got a mix of positive and negative headlines. So we got a lot of uncertainty coming from the trade trade front. So is today's mild risk on tone enough to shift the market's recent cautious stance? Stay tuned as I break down sector rotation trends and market signals and today's trade idea, which is an iron condor on Salesforce. So let's go ahead and get started. Today is Thursday, May 29th, 2025. This is the market outlook from marketscholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us on our blog here, check out some of these other things on the right, including signing up for our daily Market Outlook email by filling out this form and hitting that sign up button. You can also do that up here when you hit the subscribe free. Here's our Market Outlook Live. I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. We also put on today's trade already before the market closed in that video. I just click on this, or you can come up here and click on Market Outlook Live. Come down to the bottom. After you can see, you can read up on what happened here today as well. Come down to the bottom, click this heart. It opens up this tab. Hit that like button. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there as well. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. Let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we started the day pretty strong. And in fact, if you look at the gap here, we gapped up almost a full percentage point, 0.9%. We still finished the day higher, as you saw, but not by 0.9%, only by 0.4. In fact, at one point in time, we were actually down today. So we did come off the lows. It was a small range. I mean, even with the gap up and then the move lower, I mean, it was still, we're still just like, you can see like a half a point moves 23 points. So the average range is almost 100 points. So, I mean, the average range is well over a percentage point, like 1.5% or more. That's the average. And right now we are, at 69 points today. So as crazy as the day as it was, where we gapped up almost a full percentage, we finished, we at one point we were down pretty good. We still finished like it wasn't that big of a deal, despite the volatility, again, because of how small the range was. As a result, we came really close to getting, like during our class today, we had an intermediate confirmation signal, that oversold momentum line. And the strong bullish posture with the intermediate line up there above the 80th percentile. So that combination produces kind of like a buy the dip signal, which normally without the near term line being down in bearish territory, it's not the best. But considering the near term line is just barely starting a new run that on average lasts like 7 to 12 days, then we're still early enough that if we were to get this signal, it would have been a pretty good, and as I said in my class, we might bounce off of it intraday, and lo and behold, we did start to bounce off of it a little bit going into it, to the point where we actually don't have it anymore. The momentum line finished slightly above the 20th percentile, but the near-term line still in bullish territory. So we're still good there. If you look at the NASDAQ 100, they trade very similarly, obviously. That was up 0.2%. So we do have that signal here. So oversold momentum line, strong bullish posture, near-term line still in bullish territory, barely, but still in bullish territory, at least in the upper half of the chart. So like I would say this is a pretty, like, if this near-term low, we're just 3 days into a new near-term rally. And that's still not even close to the 7 to 12 days typical run. So we still have a long ways to go. before we have to worry about that. So I think we're pretty good on this bounce. I think this should lead. We should finish the week pretty strong. Again, simply off of this. Obviously, there's a lot of other factors that go into what happens tomorrow in the markets, but that pattern would suggest that pattern gives us the expectation that we should bounce off. We are in an environment where, unless something changes that environment, we're in an environment right now where we should bounce off of this tomorrow. The Dow Jones Industrial Average was actually a lot better. Like, we were up 0.3%, but we were well off the lows. We did not gap. Well, I guess we gapped a little bit higher, but not nearly to the same extent. When you look at the gap for the diamonds, it was only 0.25%. Again, Nvidia's earnings had a big, there's a big reason for that with the Nvidia earnings there. So, sorry, I'm on chart. So that's the main reason why I didn't do as well. And its market forecast looks a little bit better simply because of, again, we didn't jump up as much, but we did jump up more on the Dow off the lows than the other indexes. And then finally, if I look at the Russell 2000, look at 20-point move, half the range. The range right now is 39 points. We only had a 20-point move. So very, very small move. You can see the near-term line is down, out of bullish territory, but still in the upper half of the chart. We have the same buy the dip signal, oversold momentum line, a strong bullish posture with the intermediate line above the 80th percentile. So this would be a bullish intermediate confirmation signal and would suggest that we should be bouncing up. If you take a look at some other major charts here, look at Bitcoin. It's on a little bit of a pullback. It's on a near-term decline. Again, we expect that it should bounce up off of this. Neither one of these got to extreme lows. If I take a look at the dollar index, that thing has been bearish. Today it was bearish, falling as much as it has. And you can see, like, we have a bearish near-term peak potentially beginning with the momentum line falling all the way to extreme lows. So we're still on the bearish move. We had a nice 2-day rally this week on Tuesday and Wednesday, and you can see what happened here for the dollar. 1 second here. Let's take a look at the 10-year yield. Whoops. Actual chart here. There we go. And you can see it's on a little bit of a decline, right? We're down we're down at 5 basis points today. We're down this week. We finished last week at 4.5%. So we're down by 8 basis points on the week. The intermediate line's coming down. It's not in the reversal zone anymore. And you've had some, bearish. We had a pretty bearish drop here on Tuesday to start off the week. So, so we're kind of set up for a little bit of some kind of like bull tag, 3 red arrow, and then we'll see what ends up happening. Remember, we are in the range, 4.25%, 4.5%. So, we're probably just kind of stuck in a sideways move, and we're on the downward swing of that sideways action right now. Let's take a quick look at like crude oil, another important asset class. Look how flat that sucker is, just flat as a pancake right now. Crude oil is down today, but still, if you take a look at USO, you can see, it was down today, down, 1%. And, we're like, the near-term line can't get going. So we're like, we peaked, we got bear tags, we're not building on them. So it looks like we're kind of reversing down. And again, that will be kind of a function of not just inflation expectations, but most importantly, kind of economic growth expectations there. So those are some of the major charts that we're seeing from a market forecast standpoint. Let's take a look at the weekly chart now. And you can see on the weekly chart, we haven't got a higher high. You'll see that in a second. We haven't had a new 4-week high point in a long time. But we are getting a higher Hakineshi close, and that's good. And as of right now, the Hakineshi close at 58.90, we're trading above that. So we should start off next week with a pretty good bullish. It probably won't be a big body, but at least it'll be bullish. At least it would be higher, again, depending upon how we finish the week tomorrow. We should, as of right now, start off the week pretty good, even though we haven't gotten a new 4-week high point in a while. So that's actually a pretty decent sign. It's not the most bullish, but it's also not showing really signs of weakness either. We have 2 red arrows here. We don't have Red arrows anywhere. We don't have green. Well, I guess we have a couple slight green arrows, but really, like when you've got the momentum surge, you typically get momentum surges of 3 green arrows, but then that's it. Like for an example, I'll show you here. Let me go out to a daily chart on this. When you start these intermediate rallies, you typically get like a surge in momentum, and then you just get a lot of just a 1 or 2 red arrows. And then you might have, in this case, you have another surge in momentum, and then you can see a lot of white shading. So you have big surge of momentum, lots of white shading here, and you can see, you get your strong runs for a while. Well, we've had our strong run, big surge of momentum, and now we're going to get a lot of white shading, which means we'll get 1 or 2 red arrows here and there. And that's kind of how we start to grind higher. Most of the momentum's already occurred. So any continued move to the upside will be slow and grinding, but at least it'll be to the upside, because we don't have 3 red arrows right now. When you look at the 2-line version, we're above all the moving averages. We are in a convergence mode, so the MACD is below its moving average, even though we're still above the 17 days. So the 17-day being the second number in the MACD. So when you have that combination, then that means you're in this convergence mode where, the lines, the gap between these lines are getting smaller. That's why the MACD itself is falling. The gap between these 2 lines is falling, but you're still above that second line, right? The second line of the 2. The third number here is the orange line in this chart. It's a 9-day simple moving average of the blue line. So the blue line's below its own average. It's falling. It's below its own 9-day average, even though we're above, in this case, actually both lines right now. But most importantly, that second line, the 17-day. So again, it doesn't mean that we're bearish. It just means that it's another sign of grinding, right? That's a convergence mode where you still go up, you just don't go up to the same extent. And at some point in time, unless the blue line crosses back above the orange line, there's going to be a break below the 17 days, as you typically always see, like kind of like right here, right, where you were below, and then eventually the break came. And same thing here, you were below, and eventually the break came. And that happens kind of in a big way sometimes. Whenever you've had, right here's another example. You're kind of grinding, and then boom, you broke below, just kind of out of nowhere. So we're susceptible to that the longer we stay in a convergence mode like this. But we're still bullish, right? We're still pointed higher. The DMI is still bullish, and we're not above 30 anymore. In fact, the ADX, look how bullish we are. The ADX still can't get above 20. So technically, we are not in a trending state. We're in a trend ready state, but we're not in a trending mode right now because, again, when you look at, where we're at here, really since like January the 15th, we're pretty flat, from some of these levels from November the 19th, we're flat. There's obviously ups and downs, but we haven't gone anywhere since November the 19th. We closed that day at 590.30, and right now we're at 590.05. That's a long time to have no returns. So when we think, oh, we're up 20% in such a short amount of time, or however much this is, that's such a big move. The reality is it's not that big. When the reason why it's so big is because of the drop. The reality is, like, take away the drop and the bounce, we haven't gone anywhere. And that's kind of what the ADX is reflecting. We haven't started a new trend. We've just bounced off of a low, so to speak. When you look at the RSI and the CCI, they at least are bullish still. We're still above 60. We're still above 0 on the CCI. So those are still showing good signs. We still have our mature bullish trend. So we haven't lost that yet, though the blue line now is starting to move up pretty rapidly. Again, we're susceptible to this breaking the 0 if we break below that blue line. So we'll see kind of how we react to that. And then the the Bollinger Bands and the Keltner channels, when we take a look at those, here we go. You can see we're not in the upper quartile still. The bandwidth is falling pretty rapidly and still way outside the Keltner channels. So the momentum is falling too, but we're losing momentum, and that's fine. You can't have momentum. You can't have strong momentum. You can't have especially extreme momentum forever. So we're losing momentum, but at least we're still pointed higher above. Like you can see the moving average in the middle is moving higher. The bands, the lower band at least is still moving higher. Both the Keltner channels are still moving higher. So all the moving averages we saw are still moving higher. So everything is still positive, even if we are in convergence or just losing momentum on this bullish move. Because of that, we're not getting a new 4-week high point. We've gone 1, 2, 3, 1, 2, 3, 4, 5, 6, 7 days. But despite the fact that we've gone 7 days without a new 4-week high point, like we're still like the blue line, like we're still in the 85th percentile of the 4-week range. That's where we close at the 80. So we're still pretty strongly bullish. I mean, we're below the average, the 20-day average of the blue line, but we're still pretty bullish there from that perspective. When, let's see here. Let's go back to the 4-week range here. But the range, you can see the range is really dropping fast. You can see the green lines drop below 70, the red line's up because the low point moved up to here. But we haven't seen that range has really jumped up. So the midpoint is going to move up tomorrow to like probably right around last week's low point. So even though like we might not change, like we're trading a little bit lower in the after hours. Like where we're at, this number is going to fall tomorrow unless we get a big jump. This number right here, this number is going to fall down. Might not fall below 60, but it's going to definitely come out of the upper reversal zone unless we get a good strong move to the upside, simply because the low point is going to move higher and then the midpoint of the range is also going to move higher, which would make this not necessarily the 80th percentile anymore because the entire range is getting a lot smaller. You saw the range today was very small, the volume very light. So look at that, the range is almost back below the 1.5% mark. So that's a very good sign too for the markets. And again, it's boring, but at least again we're still pointed higher, and that's really all that matters right now. And then finally, looking at the VIX, this is the other great sign. We're below 20, we're below 90%. We're below the 200-day moving average on the VIX, right? That's the kind of the third thing we look at. We're below the 200-day moving average, and the VVIX is below 100. Now, we would like it to get below 90, but at least it's below 100, right? There's a few days we popped up coming off of this, smaller positive correlation. So at least we don't have that to concern ourselves with. We're still pretty positive there across all of these things. We have 3 of the 4 things that we would like to see on the VIX, and probably 3.5 because, like I said, at least we're below 100 on the VVIX. So things point, from a technical perspective, things are pointing pretty good. They're just lacking momentum, and that's okay. As long as you're willing to be boring, the market's willing to give you kind of this boring scenario and let it play out. There'll be ups and downs, and people will go kind of crazy about everything that happens on a day-to-day basis. But again, as much volatility as we had today, overall, it was still a pretty darn below average day. So that kind of puts things into context. Now let's take a look at what's driving this price action today. We'll take a look at the major asset classes, how they're performing. You can see gold's up over 15% still over the past 3 months. Continues to be, again, the best asset class. And really, if you go like 6 months, it's the best asset class. If you go over 9 months, it's the best asset class by far. If you go over 1 year, it's just killing everybody. Absolutely 40% gain in gold, and the dollar's down, but it's not down like that much. In fact, most of this past year was up. So it continues to really dominate, but hasn't been dominating lately, and definitely did not dominate here today. As you can see, gold was up at one point in time. It was up the most, but bonds were up quite a bit today too. Real estate's up. Kind of like a risk off type of a day there. Interestingly, the dollar was down significantly today, and so was commodities. Commodities were down pretty hard. Equities are all up, but U.S. equities underperforming international equities with the weakness in the dollar, and the Qs underperforming IWM. But everything kind of small range from that perspective. We talked about some of these things already. Let's take a look at it on the 3 green arrow chart. Again, the dollar, as I mentioned, was the biggest mover to the downside today. Let me look at that drop after gapping up significantly moving lower along with yields. So both the dollar and yields, try that again. There we go. Both the dollar and yields moving significantly lower. There's yields there breaking back below the 17-day moving average. MACD is below its moving average. The dollar, you can see the dollar's down below its moving averages still, but well below the 200-day, like significantly below the 200-day. The MACD is down, it's bearish, it's below zero, it's below its moving average, it's falling, stochastic's in bearish territory. So, I mean, those two asset classes are really struggling. The dollar has been this whole year struggling, so it actually didn't do so hot when we had our correction, but it hasn't been doing so hot since either when the market's been up. On the other hand, the 10-year yield during the correction was kind of flat, had a little bit of a down period right at the end of the correction there, when we were breaking below 4.25, thinking, oh crap, like it actually got below 4% at one point in time. But then it rebounded quickly and it got up to that 4.5% mark and hasn't really been able to get above it and stay above it. And that's, again, it's not good for equities if the yield, 10-year yield breaks above 4.5%. It's not good for it if it breaks below 4.25%, because that's where the Fed funds is right now. And so if it's going to break out of either one of those two things, it's going to do it, for negative reasons, right? Either inflation expectations are rising. And I say that because of this, right? If it's one thing for the 10-year yield to be rising above the Fed funds rate because economic growth is rising, because that makes the whole yield curve go up. And you can see the yield curve here, like it makes everything go up. And that usually leads eventually to rate hikes, right? That's the market is at that point pricing in rate hikes. So if I take a look here, let's pull up the Fed, the FOMC, how much were the odds of a rate cut coming up, and you can see no odds. I mean, 0% odds for a rate cut in June. I mean, that's completely priced out of the markets. So now September, like July is an off month. It doesn't have the projections. So September is your next month, and right now the odds are only 1 in 3 that there's going to be a cut 67% chance, that there'll be a cut in September. And that's, it used to be 100%. But now it's, 33% that we're not going to get a cut in December. If you look at September, in December, we have a 95% chance of 1 cut. We have a 70% chance of 2 cuts, and it drops all the way down to 30 for 3. So, we are at a 2-cut mid-cycle adjustment type move by the time we get to September, because then after that, you can see in March, there's really not, it's about the same, right? We have a 100% chance of 1 cut and 90% chance of 2, and then it starts to go down this, 65% from there for a third one. It slows down the great cut odds, and that's perfect, right? That's what the market wants. The market wants cut odds to be going out in time, and then to progressively push them off, right? Push them off, push them off, push them off. The more it pushes them off, the better, right? That's what the market wants. Now, if there's rate hike odds coming on the table, and you can see there's not, all the way out to March, there's 0% chance of rate hikes. But if the 10-year yield, this chart here, if the 10-year yield is breaking out above 4.5% with rate hike odds on the table, then now, we're like, okay, that's kind of normal. That's what this is. And the market likes that. The market does well. Now obviously in 2022 it didn't because there was high inflation, but that was the anomaly for the past 40 years, right? We haven't had a scenario like that since the 70s, where the Fed was hiking, into a correction. Usually it's hiking when the markets are pretty bullish and doing pretty well. And then, the cuts occur when the market's not doing so well, like 2008, right there. So the yield spread is up between the 10-year and the 2-years, up to 50 basis points. We do not want it to go up to 150, 200. We don't want it. It did over here during the mid-cycle adjustment, after COVID and after the mid-cycle adjustment. But that was okay. but we just do not want it to get up to its normal levels because that's not okay, right? That's the markets are bearish there. The market's like a yield spread that's falling and not a yield spread that's rising, right? That's the problem there. So, so that's kind of what that's the issue with bonds. Like bond yields, as long as they stay in the range and as long as the yield curve stays flat, then we're fine, right? The market's fine. And as you can see, we were fine over here for about a year in 06 and 07. If I were to go back to the 90s, we were fine for multiple years, right? We went sideways here for multiple years, kind of up and down, but still, you can see the short-term rate here just sideways for multiple years. The Fed doesn't raise rates, Fed doesn't hike rates or cut rates. There was a little bit of a cut there in 98, around the long-term capital management crisis. But then that was it. And then they hiked rates again there in 99 to 2000. And then we saw the cutting cycle occur, right, with the bear market. But, we can see like when you go up and after a rate hike campaign, and if it goes up and just goes sideways for a while, that's fine, right? It's the cuts that we don't want to see, right? That's when we're in like bear markets or recessions or something like that. So we've been pretty sideways now for what, 2 years going on. This would be our third year, avoiding the downward moves, right? Because that's what we just want to avoid. We want to avoid, the steep downward move. Probably not going to go down to 0% again. But even a move down to like 1.5% would be a significant drop and a lot of cut. I mean, that would be a pretty significant cut cycle that, as of right now is not necessarily expected. I mean, there was a point in time that the market priced in a pretty decent probability of 5 cuts starting in June. I mean, that's bear market. That the market was pricing in a bear market by the end of this year. That has been taken off the table. And with the dollar weakening as much as it has been, that's actually not a bad thing. Like traditionally, the correlation between the dollar and stocks has actually not positive. I mean, it was pretty positive previously, here recently, but that's not the norm, right? You can see right now the correlation's pretty positive there on a 10-day basis. But again, it's not the norm for the correlation to be positive. It's a lot more normal for it to be negative. So this has been, this past year where the dollar's been dropping and so have stocks, that's very abnormal. So if the dollar's dropping, that traditionally has been very bullish for equities. So we'll see if that ends up being the case again. Like the strengthening dollar, you can see it put a lot of pressure in 2022. And that is very normal. So we break 100 and we start to break down the new lows, getting towards 90 or even 80. See, 90s in a low point from 2021, but we've been below 90, down into the 80s and 75 levels. If we make a run down there, it probably actually would be not a bad thing for equities at all. 10-year yield, if you look at the 10-year yield and its correlation with equities, you can see it's been up and down. Generally speaking, in a deflationary environment, they have a positive correlation. In an inflationary environment like we've been in since 2021, really, you can see, let me zoom out on that correlation. You can see a little bit better because it's pretty volatile. But you can see for the most part, it's been negative correlation between yields. But you notice it's back to a positive correlation. That's, again, a reflective of a scenario where we're kind of more in a deflationary environment. Not that we're in a bear market or recession, but just that yields aren't going up anymore. That's a good sign. Yields have been in this long-term pattern. Here, let me go to a long-term chart here. And we'll do a weekly chart. Yields have been in this long-term pattern of going down, 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 but we have since moved up. But you notice that we're really converging on that 200-week moving average. If I were to do, let's just do the 50 and the 200. I'm gonna do both. The blue and the orange line here on the chart. So you can see, look at that convergence. Like the gap is really shrinking right here, and if it got really big, like we had change, but it appears that things are we're not in this as bullish as we've been. And you can see we're above the 200-month moving average for the first time in years and years. Remember, I have to go back to, let's see here. I have to go back to let me get that symbol, DGS10, and then I can get more history on the 10-year yield. So let's try it over here. There we go. So you can see we broke in the 80s. We broke the 10. This is a deflationary environment where yields just fall. But you can see we're way above the 200-month moving average now. The gap between the 50 and the 200 is rising back up to these levels again. So there is some, like, we're in this environment. But if you look at, like, you compare like the 17-week exponential moving average, the red line. Compare that to the 30-day moving average, the blue line on that chart. You can see the convergence there, right? We got really bullish, and now we're in convergence mode, and we're starting to, really kind of slow down. So, like, again, breaking out to the upside, not a good thing. Breaking out to the downside means that the economy is slowing down. Sideways, we stay in this convergence mode, and the market's like that. That's like the primo scenario for the markets. Let's take a look at how the sectors performed today. So let's bring up that chart. Again, you can kind of see a mishmash of who's been doing well. And last week it was, really not a good week at all. I remember if I were to go back here to how we performed last week, technology was underperforming, discretionary is underperforming. I mean, it's a risk-off move. Staples, utilities outperformed. So far this week here, oops, go to today. So far this week, you can see it's the flipped, right? Real estate, technology, discretionary, they all performed so poorly last week. They're all doing much better this week. And except for poor energy is just struggling both weeks, but utilities and staples now, and communication services and materials, which had been outperformers last week relative to everybody else, are underperformers this week. So it's just a flip-flop, right? We just flip-flop. So if I were to go back to the beginning of last week, you can see, we're still struggling because of how much they dropped. The rally that they've had they're still underperforming. Utilities has dropped back down, but staples is still the outperformer because it's held its value better, and it might not have gone up as much, but because it held its value better, there's not as much to recover. And you can see, just like I said, energy struggling in both environments here. Let's take a look at the breadth. The breadth, actually, last week was a bad week for the breadth. It's improved a little bit this week, not so dramatically. You can see we're actually pretty negative still on this. So when you look at, Hindenburg-Omen, you're looking at, you've got a positive rate of change and a negative McClellan oscillator. And then you come over here to, let's take a look at the new highs and new lows that we have. The new lows have to get to a pretty strong number. Both of them have to get to a pretty strong number, and neither one of them. I think it's actually 70 that they both have to get to. And neither one, like the lows is still really, really small on this, just on the New York Stock Exchange, sorry. The lows are really small. So we don't have a Hindenburg omen because of that. But still, you can see like the new highs is still pretty light. The number of stocks above the 50-day moving average, back above 300, and still hovering around 350. This ratio, number of stocks above the 200, still unable to get above 250. So as a result, you're still pretty low here. Still very, very low here, and haven't crossed above that. Remember, there's two different things. When you cross above this line, there's two different ways. One's bearish and one's bullish. You can see this one's bearish right there when you're already above 1 and you're rising, and then this one's bullish when you were you dropped way down here, but then we started to rally. So which one's which? Well, when the number of stocks above the 200-day break out to the upside, then that's what makes this ratio go up above its average. But if this ratio goes back up because the number of stocks above their 50-day break down, then you can see how that's bearish. So we're really close to like one of those two things happening. So we can either really get going and start on the bullish trend to the upside, or we're going to reverse down to the downside, at least according to this chart. But we are down here now. We are very, very low in the PPO, and we are ready to start moving up. So the breadth is kind of at this point where you know, it's either, you know, gone up so much now that it's going to, excuse me, this chart here, that it's going to roll over. Here, let's go back to the McClellan oscillator. That it's going to roll over from these levels, you know, up above at 500 and come back down again, similar to what we saw there, similar to what we saw in 2022 in August, when we couldn't maintain the strong positive breadth and just turned negative. So we're either at that point we're just going to roll over, or it's at a point where, you know, we can stay above 500 and really work our way up to the upside. So something like this would be like this, where it's like, okay, we got up and then we just stayed up and kept going. So we're at that point where the market kind of needs to decide how bullish are we actually going to be from here. You know, and breadth needs to expand, and it needs to, but it still ultimately needs to be led by the most important sectors in the market, and that, you know, by far the number one most important sector in the market is the technology sector, because of how big those, you know, how big it is on a weighting basis, a market cap weighted index, how big it is on a weighting basis. So we need this to continue to push up here above the 200-day moving average and push to the upside, and not, you know, you can see the weakness that's already forming here. You can see the strong correlation with the equities, you know, with the S&P as well. If the markets are going to go up, XOK has to lead it up. If the XOK starts to show any kind of weakness whatsoever, let's see, where's my other XOK chart right here. If it starts to show any kind of weakness whatsoever here, let's go back to XOK. This is on the daily. I mean, look at that move. Big, strong move. But you can see the momentum is already broken 100 and the relative strength is moving down. We're well above the 50-day average, but we're starting to lose some momentum and we're losing that positive relative strength. You know, we'll see, you know, if we can't, you know, turn that momentum around before the relative strength makes its way down to 100. And, you know, as long as we stay above that 17-day moving average, you know, we're fine. But you can see how it's kind of peaking and how kind of parabolic it got to get to this point. We go back here, how parabolic it got on the CCI just to get to this point in the PPO. I mean, that's a pretty strong PPO level for this is the ratio chart here. Let's go to just XOK. So there's the, there you can see the correlation, of course, but there's the strong RSI. Look at that PPO. I mean, that was a big time coming off a big low to come up to this big high, and you're just turning positive on the 50 to 200-day moving averages. So they're, you know, starting to work, the exponential starting to turn positive and work their way around to the upside, even if the simple average isn't quite there yet. So that kind of goes to show again just how strong this move has been. If it starts to showing any signs of petering out, if it, like it did last week, if it shows more signs of petering out on a relative basis, then it's going to be hard for the market to maintain the bullishness. All right, and that brings us to our trade idea of the day. Let's take a look at CRM. Salesforce just came out with their earnings announcement. Dropped down below, gap down about 3%. In fact, if you look at its daily price moves here, you can see we got down 4.5%. Gap down 4.5%, but only finished down 3.3% at one point in time. When you take a look at the stock here, CRM, and let's change this to the low point to the close of the day, and you can see at one point in time at the low we were down quite a bit, like way down. You can see the MACD, the near-term line was down, the momentum line was down, the intermediate line was way off of there. We were down quite a bit. You know what, another from 266.92, another 12 points to the downside. So 9 points is 3%. So you can kind of get an idea of just how far another 12 points lower. We were down quite a bit. But as you saw, we rallied up, and as a result, the momentum in the near-term line actually turned higher to the upside. So, and we finished higher than where we opened. So now, instead of being down 4.5%, we're only down 3.3. Got a long lower shadow, got a bull tag. We're only 2% below the moving average, which is a lot for the S&P, but it's not very much, as you can see here, for CRM. If I were to take a look at the weekly chart for CRM, You can see we got a bearish candle. We got the red arrow last week, so we're below the 10-week moving average. We got a bearish candle this week going into that earnings. PPO is flat. It's bearish, but it's pretty flat, and you can see the size of the candle is actually not that bad compared to other instances where we've been bearish. When you look at the 3 green arrow chart, let's look at the 2-line version of 3 green arrow chart. We dropped below the moving averages, the 50 and the 30. We were already below the 17 before earnings, but you notice we stopped at the point of control and bounced off of that hard this morning. The MACD is negative, stochastics in bearish territory, but that hitting that support and hitting that big volume node is a huge support there. You can see just how strong it was because of the rebound that the stock had intraday as a result. Looking at the DMI, you can see bearish pattern above 30, below 20, but you notice no trend. Like the ADX is up, but it's still easily below 20. So we'll see how long lasting this little breakout has on the bearish candle is. Looking at the RSI and the CCI, pretty bearish on the CCI, but not so bearish on the RSI. When you look at the weekly version of the CCI, we're not, we haven't crossed, we crossed below 100 a while ago, and we crossed back below 0 this week, but we're not too bearish there either. Looking at the Ichimoku cloud, we are still in the cloud, so we hit the bottom of the cloud at the lows of the day and rebounded up. The rate of change is actually still positive, still pretty clearly positive, and obviously we don't have a bearish, we lost our bullish trend, but we don't even have a weak bearish trend developing. And then you look at the Bollinger Bands and the Keltner channels, and while we were below the lower band by a large amount at the lows of the day, as well as below the Keltner channel, we finished above the Keltner channel and above the lower band, and almost finished out of lowest quartile. I mean, we're still in the lowest quartile, but not nearly as bad as it was. And you can see the band width has been coming down, still outside the Keltner channels, but coming down. So what I decided to do here was try to take advantage of this post-earnings bandwidth decline and just do an iron condor spread on it. So take a look at the iron condor. We sold the low 20 deltas on both sides. So this one was a 20 delta at the time of the Market Outlook Live. Over here, same thing. And so we sold those two, bought one strike away, so $5 wide. So I had to go 2 away over here to get to the $5 wide to keep it balanced on both sides. And this is what the chart looks like. And when I set those slices to break even and set those slices onto the chart, this is what that looks like, right? So pretty clear trend there. Why this didn't turn blue like that, but pretty clear, like we have a lot of room to the upside and pretty darn strong support here to the downside, that if we were to break this level, obviously either way, if we break either one of these, we're going to be trending in that direction one way or the other. So here is CRM. So you can see like we'd be trending back up to the upside and breaking well above moving averages, or we'd be like breaking below some major support to the downside here. So otherwise, we're going to stay in this nice steady, hopefully stay in this nice steady kind of sideways move with all the momentum starting to decline and the bandwidth, the volatility, starting to decline. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up it in your thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all tomorrow.